Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, January 30th, and today's theme is leadership changes, market plumbing, and why safe assets sometimes behave like they drank 3 espressos.
I love when markets wake up and choose chaos. If your portfolio feels personally attacked today, don't worry, mine does too, and it doesn't even have feelings.
Story 1. President Donald Trump nominates Kevin Warsh to succeed Jerome Powell as Federal Reserve Chair. Markets reacted fast. Reports said stocks and Treasuries both dipped as traders tried to price what Warsh might mean for future rate cuts and Fed independence.
So the market saw a new potential boss and went, cool, let's sell everything. That's like meeting your new manager and immediately updating your resume.
Here's the simple finance behind it. The Fed chair is like the thermostat for the economy. If investors think the thermostat might be set differently, higher for longer, or faster cuts, they reprice stocks, bonds, and the dollar immediately.
And everyone's arguing. Will he cut rates? Won't he cut rates? It's like a group chat trying to decide dinner, except dinner is your mortgage payment.
Why would stocks and treasuries fall together? Because sometimes the market is repricing risk and inflation at the same time. If investors fear less predictable policy, term premiums can rise, meaning bond yields can rise even if growth expectations wobble.
Bonds are not always the emotional support animal they claim to be. Sometimes they bite. Gently. With math.
Story 2. India's National Stock Exchange, NSE, got clearance from the securities regulator to initiate steps towards an IPO. That's a big deal because NSE is a core piece of India's market infrastructure, and this has been a decade-long wait.
An exchange doing an IPO is like a referee selling tickets to the game and then saying, by the way, you can also buy shares of the referee. Wild, but also kind of genius.
The Finance 101. Exchanges earn money from trading fees, data, listings, and sometimes clearing services. When an exchange lists, investors are effectively buying exposure to market activity, volumes, volatility, and the long-run growth of participation.
So if more people trade, the exchange gets paid. It's the toll road model, except the cars are day traders and the traffic is emotions.
Story 3. Gold and silver tumbled sharply after a strong run. Some reports called it the biggest slide in years. At the same time, U.S. producer prices rose more than expected in December, with PPI reported up 0.5% month-over-month after 0.2% previously.
Gold investors were like, we're the calm ones. And then the chart said, surprise, you're actually on a roller coaster, and the seatbelt is vibes.
Simple version? Gold and silver often trade off real yields and the dollar. If inflation data or Fed expectations shift toward tighter policy or just fewer cuts, real yields can rise, making non-yielding assets less attractive. Add crowded positioning, and you get a fast unwind.
So it's not gold is broken, it's gold is moody, like a cat. Loves you, ignores you, then knocks a glass off the table because yields moved.
Story 4. Bitcoin struggled to hold the $88,000 level, with attention on support around $85,000 and resistance near $90,000. The takeaway isn't predicting the next candle. It's recognizing that crypto is still a high beta risk asset when liquidity and rate expectations tighten.
Support and resistance sounds like therapy, but it's really just where people panic buy and panic sell. The most human technology on Earth.
Action steps for normal investors. 1. Don't anchor your whole plan on a single Fed personality. Use duration you can live with. 2. If you hold gold as a hedge, size it like a hedge, not like a lottery ticket. 3. In crypto, pre-decide your risk, position size, stop rules, and what would make you exit before the chart starts yelling.
And if your strategy is, I'll sell when I feel uneasy, congratulations, you've invented buying high and selling low. The market thanks you for your donation.
That's the briefing for 2026, January 30th. If this helped, subscribe and share the show. Tomorrow, we'll connect the dots again. Rates, risk assets, and the signals that matter more than the noise.
And remember, when markets get dramatic, your job is to get boring. See you next episode.